a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
We are revisiting small cap ETFs with our ETF research director, Nina Mishra, who's right here with me. So why is this a good time for these type of ETFs?
So small caps have been rising for the past 2 weeks or so. Last week was in fact their best week in many, many years.
Wow.
And over the past 2 weeks, they are up like 7% or something like that.
Okay.
So I thought it would be a good time to discuss why they have been rising and also discuss two most popular small cap ETFs.
Let's do that.
So easing of trade tensions is one of the big reasons. Statements made by President Trump and the Chinese side, they suggest that both sides may arrive at a trade deal soon. The hopes have risen. And then the recent economic data has not been bad. So while the trade war has hurt many other countries in the world, the US economy still seems to be doing okay, not great.
Yes.
Of course, trade tensions have hurt, but doing okay. It remains on solid footing. And these smaller companies, the small cap stocks, they are more tied to the health of the domestic economy because these are domestically oriented companies. And they also benefit from lower interest rates. And we are talking today on Wednesday. The Fed would announce its decision later today.
Yes, we are expecting that.
And they are expected to cut rates.
Yes.
This time, and maybe one more time this year, we'll see that. So lower rates in general help these small cap companies. And then, of course, over the past 10 years or so, large cap stocks have done very well. So relatively, these smaller companies, the smaller stocks look attractive now. So that is why also we saw some rotation out of earlier hot areas of the market into ignored areas like small caps and value stocks. So that's why they have been doing pretty well.
And am I correct in assuming that you see no impact of the Saudi oil situation to these small cap ETFs?
No, not much. And Saudi oil situation as such, they are saying that they may be able to restore their full supply by the end of this month. So we may not see much impact on any stocks. We'll see.
Okay. So
But
there is risk here though, right?
But at the same time, if you are investing in small stocks or small cap ETFs, remember that they are more volatile, they are riskier compared to larger stocks. So if trade talks do not go well, if we do not get a trade deal soon, these may be impacted. Then these companies are currently in an earnings recession. The earnings have not been rising, so that also you should remember. So if you have a higher risk tolerance and if you see attractive valuation at this point, maybe take a look.
All right, yeah, that is a good point, the risk issue. All right, let's just take a look at these that you brought with you. iShares Core S&P Small Cap ETF.
So we are discussing two most popular small cap ETFs.
Okay.
They follow two different indexes, one by S&P, the other one by Russell. That is why there is difference in their sector allocation, which has resulted in a significant difference in their performance over the longer term. So this, as the name suggests, it tracks the S&P's small cap 600 index. It holds 600 small cap stocks, very cheap, one of the cheapest small cap ETFs with 7 basis points in expense ratio, very popular with 46 billion in assets, and it's up about 17% this year. Now, if you want to take a look at this ETF, you can go to the quote page on Zacks.com, read our report, articles on this ETF, and also using the link, you can go to the iShares webpage for this stock. And you can look at holdings and sector allocation. Now, if you look at holdings, you will not recognize those companies because these are mostly smaller companies. So don't expect to see the likes of Apples and Microsofts and Googles over there. Mercury System selective insurance, FTI, consulting. And you will see that the weights are also very small. If you see a large cap market cap weighted ETFs, they are dominated by those big companies because these companies have small market capitalization. Now looking at the sector allocation, industrials, financials, then information technology and consumer discretionary. Now, industrials and financials, these have done very well in the past 2 weeks or so when we saw the rotation out of earlier winners into these earlier losers. So that is why this ETF has done pretty well of late.
And then the iShares, as you said, Russell 2000 ETF.
So this is the most popular, a little more popular than the earlier one. This, as the name suggests, tracks the Russell 2000, the very popular index of small cap stocks. Okay. So this is more diversified with 2,000 small cap domestic stocks, slightly more expensive than the earlier one, 19 basis points, and as I mentioned, most popular small cap ETF. It's up about 18% year to date. So you can again go to the quote page on Zacks.com and read our articles. You can go to the external homepage, iShares web page for this stock and look at other details. Now, again, holdings you will not recognize: Novacure, Haemonetics, Trex, Maximus. But look at the sector exposure, that is important. Financials, healthcare, industrials, and information technology. Now, healthcare is the worst performing sector year to date still. Financials is one of the worst performing sectors, so that is why earlier this year this ETF was lagging. But now, as we saw again, that rotation into financials with some rising rates and all, so that is why this ETF has rebounded in the past few weeks or so. Now, this has a lower exposure to industrials and information technology. Particularly information technology compared to the other ETF. So that is why if you look at the longer term performance, this has lagged behind because technology did so well over the past few years. So
just to clarify, because I'm looking at the percentage of exposure in each of those sectors, on these ETFs, because they are riskier, is there a correlation between the amount of exposure in a sector and the amount of risk to the ETF?
Yeah, definitely. Cyclical sectors are generally riskier, more volatile, I would say. Okay. And whereas there are some more defensive sectors like consumer staples, utilities, and REITs, which are generally more stable compared to more growthier sectors like technology and industrials, which are more cyclical in nature.
Okay, so you have compared these in a couple of different time periods, right?
Yes, so I wanted to show their performance over the past 2 weeks or so. You can see that both these have surged up 7.58% compared to just 3.5% return of the S&P 500 index. So that I wanted to show the recent resurgence. And again, on this slide, I wanted to highlight how these two have performed over a longer time period. So I have a 5-year chart over there. And because of the difference in sector exposure, you will see that there is a significant difference in performance. Now, both these have lagged the S&P 500 index because, as I mentioned, larger companies, particularly tech giants, did so well in the past few years. So that is why S&P 500 index is up about 65% over the past 5 years. The S&P 600 ETF is up about 59%, whereas the Russell 2000 ETF is up just about 46% over the past 5 years.
Okay, do you own either one?
I do not.
All right, thank you for that. And don't forget, in addition to being able to watch Nina on these videos, you can also hear her. She does a weekly ETF Spotlight podcast that's in the podcast section of our website, Zacks.com. All you need to do to get to it is go to the home page, scroll down to the very bottom, click on the word podcast, and it'll take you right to it. And as always more ETF information in the ETF section of our website. Articles, commentaries, etc. Use the Funds tab in the top toolbar to get you there. With Nina, I'm Terry Ruffalo.